Good morning, ladies and gentlemen. Welcome to the SYS Group PLC interim results for the period ended 30th of September 2021 investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged. It can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via Investor Meet Company dashboard, and you'll be notified once these are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Adam Binks, CEO, and Martin Audson, CFO of SYS Group PLC. Good morning.
Good morning, and thank you for the introduction. Yes, good morning, everybody, and thank you for once again taking the time to join us for SYS Group's half year under our FY22 period. So just a quick introduction for those of you that don't know us. My name's Adam Binks. I'm the Chief Executive Officer of SYS Group. I've been with the business since 2014. I was appointed as Chief Executive back in 2018. And my colleague over here, Martin Audson, who's our Chief Financial Officer, who's been with us since July 2018. Look, I appreciate many of you on the call will know who we are and what we do. But for those of you that are new to SYS Group, I'm just going to spend the next 5 or 10 minutes giving a quick overview of who we are and what we do, just as a refresher, and obviously to bring anybody up to speed that is new to the business. So we are an AIM-listed managed IT services and cloud hosting provider. Our full year, last financial year, we reported revenues north of 18 million. We delivered adjusted EBITDA of 2.9 million. We're employing about 110 people across 5 different locations in the UK, being Liverpool, which is our headquarters, with an office in London, our new sales and marketing office in Manchester, which we opened earlier this year, with an office in Newport and another in Telford. So we're providing predominantly consultancy, cloud hosting and connectivity services to the UK mid-market, and looking after around about 700 plus active customers. We operate the business on a 24/7, 365 basis, so we're always available to our customers. As you'll know, IT is pivotal to what most businesses do now in order to transact their own business. So we make sure we're always here to support them. And again, we maintain our greater than 97% customer satisfaction, which is a big KPI for us. It's really important for customer retention, and making sure that we look after and support well those people that we do business with. So just down on the bottom right-hand side of the slide, you'll see some well-known logos there in terms of big vendors. Kind of shows the barriers to entry for businesses coming into this market space. You know, it's not simple to set up a managed services business. You need to have the technically accredited people and sales staff within your business. And we invest a lot of time and effort with our partners, such as WatchGuard, Microsoft, and Dell, which puts their logo next to ours and gives great credibility when we go out to pitch to new businesses. It really shows that we're invested in technology and that we're market leaders in that position. And as well as that, supplemented with our accreditations, you know, we've got the Cyber Essentials, we're ISO 27001, and we're also a Visa merchant service provider, level 1 provider, meaning that we can host credit card data to the most secure standards out there and help get our customers through their annual audits from the PCI DSS Council. So in terms of our capabilities, as I said, we're a managed IT services provider with huge cloud hosting capabilities. We have presence in 5 major data centers across the UK. The picture that you see over on the right-hand side of the screen there is actually, you know, it's not a stock image. That's one of the data centers that we have about 100 racks worth of equipment in, which is now known as CWL1 in Newport. It used to be known as Next Generation Data until it was acquired earlier this year. So we host our infrastructure quite strategically across different parts of the UK to give not only geographical diversity, but also low latency network interconnects between those data center footprints. And I'll talk a bit more later on about our SYSGROUP platform, but SYSGROUP is our equivalent, if you like, of a Microsoft Azure or an Amazon Web Services platform, which is architected in a hyperscale fashion, meaning that we can deploy workloads for customers over multiple locations, being the 5 data centers that you see on screen there, as if they were all running in the same building, which gives great diversity to our customers and also allows for us to be able to take sites offline for maintenance and also suffer outages without customers noticing it. Our network, when we acquired Hub Network Services back in June 2019, we pretty much fully integrated the network right across the business now, and we're running all of our connectivity and data transmission off the back of that network. As you can see from the map there on screen, it runs right around the UK, meaning that when we bring customers into the business and we shift their workloads and their line of business applications into our data center locations, we can also provide the connectivity to their head offices and to their branch offices to bring their connectivity experience as close to the data as possible without the need for traversing the public internet. So a nice big 10 gig fiber network ring that we partner with many different operators on to give us diversity, providing 100% uptime on that network to date, which is fantastic news, and meaning that we can keep our customers always connected. And from our telehouse and our NGD presence, we also plug into Amazon and Azure, which really helps support our hybrid cloud model, where we use stuff in our data center to service people's requirements. And then we also make use of the public cloud, such as AWS and Azure, to support workloads that are right for those facilities. So in terms of what we do, we split our offering down into these 7 core areas around cloud services, connectivity, managed IT, security, disaster recovery, professional services, and raw infrastructure and hosting. What this means, whilst this is quite a busy slide, those of you who've heard me before, I always say this is a very busy slide, but it helps demonstrate the breadth and depth of the service offering that SYSGROUP has. So customers can take a very small portion of it, or they can take all of the things that we can offer to them from each of the 7 circles on the slide. It's fantastic when a customer buys everything from us, but it's very few and far between, unfortunately. So, we do try to prosecute the white space that we have in the customer base all of the time. But in terms of our capabilities, businesses, especially since the pandemic now, are looking to move to more of an outsourced model. They want to be able to have a single point of contact, so they don't need to call the connectivity provider when there's an issue, for the connectivity provider to say it's your hosting provider, or they've got some issues with the actual equipment that they're using to access the hosted infrastructure, such as your desktops or your laptops. So to speak, they want one throat to choke. And I can see that the industry is moving more and more towards that model of wanting to procure everything from a single supplier. Hence the reason why we've made the acquisitions that we've made in the past, and we've built out the service portfolio in order to give us the offering that we've got to date. So just moving on now from the update on the business, before we get into reviewing the half one period in FY22, we've embarked on our ESG strategy for the first time, and I'm going to let Martin give a little bit of an update on that before we move on.
Yeah, okay, thanks, Adam. Just to give you an update on this, we decided this for the first time we're going to embark on an ESG project. We're not actually required to do this, as I'm sure you're all aware. in terms of our size, we're not hitting any of those thresholds that make it mandatory. However, we've taken a decision that we think on a voluntary basis this will be a really good thing for us to do. There's a number of reasons for that, as you can imagine. One of them is we've got an investor community that's very interested in ESG and wanting to understand what their companies and investments are doing in this area. We also acknowledge that there's headwinds here around the regulatory regime, which might take a number of years to go, but it's heading in our direction. But also, and I think this is quite an important point we want to make, we really want to do this properly as a company for the good corporate citizen that will give us and allow us to do. So we're very keen to get this embedded in our business. So to that extent, just in the last couple of months, we've engaged a company called Inspired, who I'm sure some of you will know. They're a fellow AIM-listed company. They have their own ESG advisory division, and they're going to be working alongside us over the next 2 to 3 years, helping us on this journey. So they're Inspired are working with our senior leadership team. They've already started that. It's kicked off in the last month or so. And certainly in year one, as this will be, we're keen to get ourselves benchmarked, see what we do, and get that reported for our annual report next year, which will come out in June. So really, year one is where are we today? What are we doing? We are doing some good things in this area already, and we'll get that reported. So you can expect to see in our annual reports disclosure on the TCFD and ESG area. We'll then move on and take that forward in year 2, year 3. So it's a big project for us, very keen to get on with it, and we think it's a very good thing for us to do.
Very good, thank you. So moving on into the first half of the year, look, we've reported a revenue down since the same period last year, which we'll talk more about as we move through the deck. But still a nice strong 7.58 million of revenue in H1, 86% of which was delivered from our recurring managed IT services business, really demonstrating the strength of our contracted recurring income. And adjusted EBITDA coming out exactly where we expected it to, at 1.34 million. Great cash balance of 3.47 million. So, still demonstrating great cash generation from operations. As I said earlier, we're maintaining the threshold on our customer satisfaction. We're still north of 97% for that 6-month period, and rolling on into the months in H2. We've continued to maintain that. I said I'd talk some more about our investment into our SYSGROUP platform. So we've invented SYSGROUP 2.0, as we're calling it internally. And actually, we're taking the opportunity to consolidate some of our data center space and make better use of the footprint that we've got in the the CWL1 facility that we've got in Newport in South Wales. And in this financial year, we'll probably invest about £200,000 of capex into expanding that SYSGROUP platform for future growth and resilience, and taking it up a level in terms of the next layer of technology. And as Martin has just nicely walked us through, we've commenced our ESG journey, albeit as a voluntary thing. We're not mandated to do it, but we think it gives us good standing in the market. It puts us up there with the bigger AIM-listed companies that and acting more grown up and being a good corporate citizen, to demonstrate that we are trying to have an impact on how we impact the environment and the surrounding governance and social enterprises around that. So Martin, if you want to take us through the financials.
Yeah, okay, so we've got 3 or 4 slides for you, just to talk you through our headlines, and we'll go through the primary statements and I'll explain that for you. So in terms of the headlines, and I'll talk about revenue a little bit more on the next slide, but revenue's 7.58 million, as Adam's mentioned. It is down on the comparative period last year. I'll talk, as I say, a bit more about that in a moment. Recurring managed IT services. If you've been on these calls previously and seen our RNSs, we've already talked about a 75%, 25% model, or having 75% contracted income 25% what we call value-added resale, which is the one-off sales of equipment and licenses. I think what this is showing now over a number of periods as we're going through is we're moving to an 80-20 model now. So we're moving up the scale in terms of having that contracted income. The adjusted EBITDA, 1.34 million. So it is slightly down on H1 last year, but absolutely in line with our expectations. And our expectations indeed for the full year are held and as expected and forecast. Adjusted PBT is similar to last year. But one comment, I guess, on the EPS is you'll notice that it's 1.5p, 1.7p last half year. We've actually absorbed what is a deferred tax adjustment in the first half, which that's about 140k. And this is to do with the change in corporation tax rate in April 23. So this is something I'd imagine is going to affect all companies. But because that change in corporation tax rate has been enacted now, the deferred tax has to be recognised this year. So in the first half year results, our tax charge includes a one-off adjustment. That's had a 0.2p impact, negative impact on the EPS, but that will be something across all companies. Net cash is very strong, and I'll talk more about that on the cash flow slide. So this is the income statement for the half year. So I'll just run down and give you a little commentary on this. So in terms of the revenue reduction, revenue is 16% down in total against H1 last year. Within that mix, managed services is down 13% and value-added resale is down 30%. And we've got several dynamics around this number, and it's worth, I think, just putting some of these out. And indeed, Adam will talk a little bit more about these in terms of the market position after the financials. In terms of managed services, in FY21, you'll recall that we had a revenue decline, clearly very much strongly linked to the COVID pandemic and the effect that had on the economy at that time. What's happened in that time is we've had churn, higher churn than usual. And churn is two things. There's contract churn and customer churn. Now, what we've found in terms of the churn we've had to, or we've found, is that we can typically have a customer that has 10 or 12 contracts with us. And what they've done on renewal during the COVID period is they've maybe typically had 100 users, and they now need to have a requirement of 80 users. So whilst contracts are still there, if you like, the churn within the contract is reduced. So what we have is a customer base, or some of our customers in that period on renewals have taken the opportunity of moving down their own costs where they can. So that's what's impacted managed IT services. And because we had that reduction in FY21, we've entered FY22 at a lower managed services income level compared to the comparative period last year. So that's why we've got this trajectory downwards, which we're in the middle of in this half-year period. Obviously, we'll come on to the market today and how we see that going forward and how we think that will come round. Just in terms of value-added resale, another dynamic which we're seeing is it's been an interesting period these 18 months. So as you'll have heard, IT has got a lot more on board's agendas over the last 18 months for obvious reasons. What's happening at the moment, and this is from conversations we've had with a number of our customers, is they're recognising absolutely the need to move to cloud transformation and digital transformation. But what they're doing is taking the time to work out how to do it, because it's not, there's some complexities to it. It's quite a lot of project management to get through. Now, what they're doing, or certainly in some cases, is where they're on an on-premise solution, is they're extending the lives of their on-premise equipment for another year or so, which is therefore affecting our value-added resale. So we're not getting the cyclical VAR and tech refreshes. But on the positive piece on that, it's good news that they're doing that insofar as they're considering the transformational piece, which then lends itself into our managed IT services and our cloud hosting. So that's a bit of a dynamic that's happening at the moment. It's why our revenue is down at the moment. But as I say, we'll address where we see the market just a little bit further on. In terms of gross margin, pleased that we've retained gross margin at 60%. I think that's a strong position. Obviously, in a revenue down position, I think it's strong that we've got that resilience where the margin sustains. It obviously draws the point that if once we get this revenue moving upwards, we've actually got an opportunity to leverage the gross margin higher. So we'll be looking to do that in the future. Overheads are in a very good position. They've been controlled very well, not just in this last 6 months, but throughout the COVID period. The synergies post-acquisition, we had acquisitions back in 2019, have come to full realisation in this half-year period. And actually, when you look at the overhead base, we're kind of where we were a couple of years ago, just at the point of making those acquisitions. So cost synergies have come through very, very strongly, which is good to see. Just to reiterate the point, and maybe particularly for people who are on this call for the first time, we didn't furlough any employees throughout the COVID period. There's not been any one-off credits in our income statement at all. I will draw out one point, and you'll see that on the tax. I just want to reiterate this: the tax charge has gone to a 83k tax charge this half year. As I say, that includes a 140k one-off deferred tax charge for the enactment of that change in rate. So just move to the statement of position, aka the balance sheet. Again, I think this is a fairly straightforward balance sheet to understand. It's in a strong position. We've got cash, gross cash of 3.5 million. We are a cash generating business. It will continue to generate going forward. We've got net cash of almost 2 million after you've taken off the loans and any liabilities. That will continue to grow, and we're expecting net cash to probably be around 2.6, 2.7 million at year end. In terms of the major movements in this half year, we took the opportunity of refurbishing our Newport office, and we've opened the new Manchester office, which we mentioned back in our June call. Both of those have been excellent jobs to do, and as our teams have come back to the offices, they've been pleased to see some new, refreshed looks to the offices. So that's been good to do. But I guess from a financial point of view, it's obviously non-recurring capex. So it's about 300k of non-recurring. Lease liabilities have gone up, just the Manchester office lease. Intangible assets. Project Fusion has continued. Project Fusion has been an excellent internal project for us. We went live with a new unified set of operating systems last year at FY21. And this year we're building it out further. So we've built out further the marketing module, the people management module, and further reporting quality of the system. So it's been a really good project. The investment in that is at a lower level to last year, but it will continue all the way through to year end. Just a word on working capital generally. Working capital is unchanged. It's in a very good position. We operate a debtor days target of 25 days. We're slightly below that at half year. Supplier payments absolutely unchanged and paid as normal. So working capital is running well for us. And again, just a note for people maybe who've not been on this call before. We've not taken any COVID loans at all throughout the period. There's no deferral of tax payments in our balance sheet at all. One thing we did do last year was defer the VAT payment, and that was repaid actually in December 2020. So it's a clean balance sheet insofar as any COVID elements. If we just move to the cash slide. So I mentioned we're strong in the cash position. We have cash conversion of 85%. Just a note on that one, and for those of you who've read our RNS, you'll see that we've changed our cash conversion calculation this half year. What I did was take the opportunity of looking at our peer group, our listed peer group, just to see how other people measure cash conversion. And what I've tried to do is align it with what everybody else does. Previous to this half year, our cash conversion included working capital movement, interest payments, and tax payments. What we've now done is worked out cash conversion after working capital only. So we've removed the interest and the tax. So that's just in terms of putting it alongside our peers. Working capital cash conversion is strong. 85% is target range. It should be same level at year end. Last year, I'll just make the comment on the last year number of 120. 124%, just in case anybody's looking at that. That included the benefit of VAT deferral at that point, which is 280k. So 20% of that 124% was because of the deferred VAT payment at that time. The CapEx expenditure that I've mentioned includes the office refurbs, so that will come down in H2. Project Fusion, I've mentioned, will probably be a similar level of spend in H2. Our bank loan repayments have gone up slightly, so we have a 5-year loan facility agreement, which was dates back to February 19. So just as part of that agreement, in year 3 that steps up in the 3rd year, and that'll be an additional 100k for the full year versus last year. Lease payments, other than the Manchester office, are generally coming down, and we expect them to come down. We tend to buy rather than lease where we can. Just worth mentioning, we still have the revolving credit facility for 3.25 million with the bank. It's undrawn at the moment. So I guess when you put these pieces together, and again we'll talk about M&A in a little bit, the firepower we have is we've got a good cash position, we've got a growing cash generation, we've got a net cash that's going to be going up for the year end, and we've got the RCF to execute certainly on the smaller acquisitions if we need to. So I think overall cash and net cash is in a very strong position.
Brilliant, thank you very much. So look, moving on to the current state of play with the market and kind of feeding into our revenue down position, which, you know, whilst it's slightly disappointing, it's almost not unexpected, and there's some very good reasons for it, some of which Martin's already alluded to, talking through the financial slides. You know, we've been busy talking to our existing customer base, as well as talking to new potential customers from our prospect base. We spend a long time nurturing opportunities and leads that come through into the business before we convert those into sales. And the biggest message that we're seeing right now, and I know this is the case for certainly our peers as well, having spoken to some of my counterparts in our peer group, is people are delaying the decision to commit to long-term IT contracts. They're delaying decisions to commit to contracts in other areas of their businesses as well. But obviously what we're interested in is their IT spend. And the biggest reasoning behind that we're seeing is fear and uncertainty. People still aren't convinced of where the outturn is going to be from the pandemic. Obviously, we're still in a pandemic. There's still rumours on a daily basis of another lockdown, which I think many people are frightened and disheartened by. I know I certainly am. I could certainly do without that. I enjoy being back in the office. But yeah, there's still a lot of uncertainty out there in the market. People are aware that they need to invest. They know that they need to do things differently in order to drive their businesses forward. But I think many are still getting comfortable with their own financial positions and really trying to scope out whether we're out of the thick end of the pandemic, if you like. But, you know, we are starting to see some green shoots of opportunity from the efforts that we're making with our customers and our prospects. You know, people know that they also, if they're going to move from this on-premise infrastructure where they've got some servers stuck in a stock cupboard that have been there for years, they know that they need to engage with third parties to navigate the technical complexities of all of the different solutions that are available to them out there. You know, a lot of people are of the mindset that don't know that it's very simple to log into Microsoft Azure or Amazon Web Services and spin up an entire environment. And, you know, they kind of transfer the files across and off they go. That's not the case, and many find that not to be the case once they try to embark upon that journey, or even worse, actually go off and do something like that. There's so many complexities around security, around management, around instance management, that rely on having really good technical people who understand these platforms to manage it for you and put the right workloads in the right environments. So our business is still very, very relevant because, I've said it before, I'll say it again. We're not afraid by the public cloud. We embrace the public cloud where it's appropriate to do so. We use our Amazon Web Services and Microsoft Azure ourselves, and we couple that with our private cloud and our multi-tenanted SYSGROUP platforms to ensure that our customers are getting the best possible experience and the best value for money. Again, by using the right platforms for the right workloads. One of the other recurring themes that's starting to come through now, it's in its infancy, but it's definitely there, is costs are increasing in the public cloud. So, I always tell people, if you're a startup business, you've got very little capital to get your business off the ground. Starting in the public cloud in an Azure and an AWS is absolutely the right thing for you to do, because you can scale the resources up and down so easily. You can run minimal instances. You can keep the cost base really, really low. You can turn it off when you don't need it and save cash. But as a business starts to grow, as user count starts to grow, there is an inflection point where having everything in the public cloud outweighs the benefits of having things in always on data center environments. And it's the hidden costs that people don't understand. There's no such thing as a firm quote that you will ever get from Microsoft or from Amazon for their platforms. It's always an estimate. As your data goes in, that estimate can go up or down. And the hidden and unknown costs can start to really rack up in these public cloud environments if you choose to try and run your line of business applications that aren't designed for the public cloud in those services. So off the back of all these conversations, pipeline is starting to grow again. It's starting to build. It's not yet at pre-COVID levels. I'm sure as we move forward into calendar year 2022, and more confidence starts to come back into the marketplace, and we're seeing more people mobilize back into offices and whatnot, that pipeline will grow even further. And as I said earlier, from that pipeline, we are starting to see green shoots of opportunity, which is great news. And I'm hoping that trend will continue and accelerate throughout the next 12 to 18 months. So, the opportunity that's created by all of that is hybrid working. I think is something that is definitely going to be around for the long term. I think many people have enjoyed the flexibility of being able to have some office days and some home days. I know some people just prefer the office, some people just prefer home, but I think the vast majority like the hybrid model. And I think businesses are recognizing that they need to support the hybrid model. It's exactly what we've done in our own business. But what that drives is the need and the demand for businesses to make their business systems and their data available easily and readily for their employees to be able to access pretty much from anywhere in the world. And that drives us into cloud hosting and taking those line of business applications and that data from on-premise instances into the data center and into the public cloud. I read a KPMG report from a couple of months ago that 56% of business executives agree that cloud migration has absolutely become a necessity for their business. It doesn't mean that they've done it yet. But they know that they need to, and it's necessary for them to be successful moving forward. And the great thing about that is that drives the need for security. And as many of you will hear me say before, everything that we do at SYSGROUP, whilst we're not just a managed services security provider, it forms a lot of what we do around security, compliance and governance, and that's where we've got some real strengths in our offering. And when people do make the decision to move their systems and their IT estate into the data center, is we've got experts that we employ that can help secure those environments to keep the data protected as best as we possibly can. So I mentioned earlier the need for hybrid cloud. So, we have to embrace the public cloud offerings from Azure and from AWS. But also we have some great advantages of being able to host infrastructure and data in our SYSGROUP platform and bring the connectivity into that as well, which is a true end-to-end hybrid solution. So we are well placed to deliver hybrid solutions to our customers and to our prospects. And I firmly believe, given the research that we've done, that it's hybrid solutions that will drive the future growth and drive the demand and the transition into the data center and into the cloud. So, look, it's apparent managed IT spend has declined across the sector as a result of COVID. I think we can pretty much certainly attribute it to COVID. Martin mentioned earlier the difference between customer churn and contract churn, and it's certainly contract churn that we've seen on renewal with our customers. Not all of the customers, obviously, but some of them who have faced financial difficulties as a result of COVID themselves. They've had to let employees go. As a result of that, you need less resources in your IT estate, and therefore you reduce the amount of resource that you've got. You reduce your licensing costs. You don't need as many Microsoft 365 licenses moving forward. But most of those businesses have got a plan as they come out of COVID to return to growth. They're still working with SYSGROUP, which is great. And that means that together we should grow again in the future. We should see the demand come back from those customers for more resources as they're able to re-employ those people and grow their own businesses at the top line again. And the UK managed services market, including the cloud hosting and connectivity, at the moment it's worth around £12 billion. So you can see there is a huge spend on managed IT services, and there's a huge market to go after. And SYSGROUP has been very successful in the past at displacing incumbent providers and winning business from our competition off the back of our great customer satisfaction, our great customer journey experience, and our technical competencies that we have within the business. But to add to that, the difficulty that we're seeing as I say, we're having lots of conversations, but the difficulty that we're having in converting business is because of the uncertainty, because of the fear. People are delaying decisions to spend because they're reluctant to embark on large-scale projects right now, which takes their data, takes their applications from either on-prem or provider to provider. However, I'm confident that that will return in the medium term. So look, why should you guys keep supporting us? Your support today, we're really, really grateful for. We're grateful for the institutional support that we've got, but we're underpinned by contracted recurring income. I think we've demonstrated that through the number. You can see from the sales mix, 86% of it is coming from recurring income. So we've got good visibility of our future revenues. We're turning that revenue into profit and in turn into cash, as we've got great, strong cash generation. Our institutional shareholders are really, really supportive. We've spoken to most of them yesterday, immediately after announcing the results, and we've still got them all behind us. They're all invested with a medium to long-term view in SYSGROUP, and they understand the impacts that COVID has had across the sector, but they also understand that the sector is forecasted to return to growth, and we will see people spending on IT once again. M&A still very much forms part of our stated strategy. The market in which we operate is still hugely fragmented. There's great opportunity for us to make acquisitions, both bolt-on and strategic, and we're still well and truly committed to that M&A strategy. And as Martin alluded earlier, the cash we've got in the bank, the undrawn debt facilities that we've got great firepower, and we're well placed for when the market settles to continue to make acquisitions. And SYSGROUP is operating in a growing market with high future demand. As I said in the previous slide, the future demand is definitely there. We can see it. We're talking to people. We're hearing it all the time. People want to make decisions. They're just withholding from making them at the moment. And you've still got a fantastic leadership team and a fantastic board of directors and a fantastic senior leadership team in this business that is committed to the success of SYSGROUP. Whilst it's been a bit of a bumpy period, I think for everybody, way beyond SYSGROUP, we've by no means given up. The drive and enthusiasm is still there to take SYSGROUP forward and be the success story that we really want this business to be. So, look, in summary, to summarise what we've just said, great recurring revenue, 86%, delivering 7.58 million in the period. Adjusted EBITDA is well and truly in line. We've done a great job of managing the cost base and making sure that doesn't get out of control. We've remained disciplined on it. We're turning that EBITDA into cash, which is a really strong KPI of performance for the business. 85% operational cash conversion, which is what we target. We continue to look after our customers, right throughout this whole pandemic. I couldn't be any prouder of the team than what I am, on the basis that they've still managed to maintain the high levels of customer service that our customers are accustomed to and that we strive to deliver. Project Fusion, which Martin talked on earlier, has been fantastic for our business. It's made such significant improvements in the operations. We really can run the business from a single pane of glass. You get many businesses that embark on M&A strategy and they forget to integrate. But I think we've done a really, really good job of integrating the acquired businesses, integrating the customer bases, the service offerings, billing, customer service, everything into a single system. Even from a corporate point of view, we've actually hived the trade and assets of those businesses up into a single trading entity, which makes it really, really clean from a reporting perspective. And obviously, we're being a good corporate citizen that we'd like to be. We've embarked on our ESG project to give greater transparency out to the market, and we look forward to giving you a much fuller update on our ESG discoveries at the full year in June in 2022. So look, thanks for listening to me today, and I'm happy to take some questions.
Fantastic. Adam, Martin, thank you indeed for the presentation today. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just by the team, take a few moments to review those investor questions submitted already. I'd like to remind you that recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order the company can better understand your views and expectations. Adam, Martin, we've had a number of questions come through, and perhaps I could just read out the first one and we can start with that. It reads as follows: who is your competition and what advantage do you have over this competition?
Look, it's a good question. As I said earlier, it's a fragmented market, so there's lots of competitors out there ranging in various different sizes, shapes, and forms. If I just take our listed peer group, you've got the likes of IOMart and you've got the likes of Adept Technology Group. If you take an IOMart, for example, what's our competitive advantage over them? It's probably the breadth and depth of our service offering. We're more managed IT than we are cloud hosting, so we go beyond the infrastructure for the customer. We support end users. We support the platforms that those end users use to access the data center hosted services. We've got the security capabilities. And then, you take somebody like an Adept Technology Group. Those guys have been doing a fantastic job in their M&A strategy. They're very big in public sector. But again, strategic advantages is we're more of the managed IT services piece. I think we just need to do a better job about shouting about that from the rooftop so people really know the differences.
Fantastic.
So, yeah.
Thank you very much indeed. And the next question we've got here is reads as follows: is the recent reduction in the group sales purely down to COVID, or are there other factors at play?
Yeah, I mean, look, it's largely down to COVID. I'm not going to blame it 100% on COVID because I think it would be unfair to do so. We do, same as every other business, from time to time lose customers either through acquisition, through liquidation, or just because they find a better deal elsewhere and something that's more suited to them. And that's exactly how we win customers as well. We take people away, we take customers away from their incumbent providers because they find a better deal with us. But certainly this revenue decline that we've experienced is largely down to COVID.
Thank you very much indeed. The next question we've got here is: you're an acquisitive company. What gaps have you got in terms of product or geography? What criteria, including financial, do you look for in a target company?
Okay, good question. I'll answer the geography piece first. Geography, I used to be quite focused on, and it was one of the advantages of when we bought Certus down in Newport in South Wales. It kind of gave us that South Wales coverage. However, I think COVID's transformed things a little. Geographical coverage doesn't really matter. But still, when I look at the map and see that we don't have a presence up in the northeast of England, it always makes me think, could we be doing better up there if we did have a physical presence? And I think that's still yet to be determined as we come out of COVID and more people come back. But in terms of, is there anything missing from the portfolio? I don't think so. If you go back to earlier in the slides, the fourth or fifth slide, you can see we've got that real breadth and depth in service capability. So our acquisitions now, we're looking for more of the same. We're looking for real scale. And in terms of what we look for in acquisitions, I mean, there's a number of criteria that I'm not going to give away on this call. That'll be available for all to see moving forward. But recurring revenue is one of the biggest things. We're always looking for recurring revenue. I've said it before. We could do a deal a month on businesses that claim to be managed services providers, but actually they're resellers of licenses. So contracted recurring revenue for services is one of our biggest requirements when we're looking at purchasing a business.
Thank you very much indeed. And the next one we've got here is: the company is active on Twitter and makes a reasonably large number of posts. Engagement levels with the tweets appear fairly low. Has the use of social media resulted in new contracts or business?
What a great question. I ask my marketing director this all the time. So it's nigh on impossible for a business in our sector to measure what we're getting from social media. Social media is more about presence and brand awareness. So it's a difficult question to answer.
Thank you very much indeed. Perhaps if you could have a quick look on the Q&A tab, just to see if there's any further questions that you could pick up, guys, before we perhaps redirect to investors to give you a bit of feedback.
Yeah, let's have a quick look. So we've got, can you give an idea of breakdown by sector?
Well, look, do you want me to just quickly take that one? I mean, just in terms of our sector, we're very diverse across industry sectors. So our top sectors, both of which are around 10-11%, are financial services and actually IT technology customers. Across other sectors, that then goes into single figures. We don't deal on very specific verticals. That's not how we work in SYSGROUP. Our services can be offered across all sectors, and that's how we sell and market. Over the COVID period, one of the reasons why we had that resilience was our leisure and hospitality areas, about 5-6%. So pretty diverse, but equally in terms of how we sell, we can sell to all industries.
Fantastic. Thank you very much indeed. Martin, and perhaps Adam, just before we do close off, if I could just ask you for some closing comments. And of course, any further questions that do come through for the company, they will be able to review and publish responses where appropriate to do so. If I could perhaps hand back to you, Adam.
Yeah, absolutely. Look, SYSGROUP is still a very strong business. As I mentioned, we've got great recurring revenue. We've got solid cash generation. We're operating in a market which is going to return to growth. And I'm really confident about the future success of business. And I'd just like to thank everybody for taking the time to join us today.
That's fantastic. Thank you very much indeed. Adam, Martin, thank you very much for updating investors today. Can I please ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of SYSGROUP PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you very much and good morning to you all.